Welcome back to the ProTicker Podcast. It's your Saturday morning edition, and we're covering the major financial magazine headlines. This week has been a whirlwind. Market swings, global developments, really demands a closer look. We've got ESG controversies, Bitcoin surging, trade tensions brewing in North America. A lot to unpack.
Yeah, it's been one of those weeks where you really need to understand the nuances and the connections between everything that's happening if you want to navigate the financial landscape.
Absolutely. Let's kick things off with a story that's shaking the foundations of ESG investing. Bloomberg is reporting that Gautam Adani, head of the Adani Group, is facing indictment by U.S. prosecutors on bribery charges. This is related to Adani Green Energy, a major player in India's renewable energy sector.
And what's really striking here is that Bloomberg found over 770 ESG funds with something like $400 billion in assets, held Adani Green shares. And this is after previous allegations of fraud against the Adani Group. So you have to wonder about the due diligence practices of these funds.
Right. If over 770 ESG funds held these shares, despite those red flags, it does make you wonder, how effective are their screening processes, especially when it comes to governance in emerging markets? Bloomberg actually quoted Henry Kinnersley. He's the co-founder of Snowcap Research, and he was short-selling Adani Green. And he said the company's terrible governance was in plain view.
And it's not just short sellers. Bloomberg also quotes Mohit Mirpuri. He's a portfolio manager at SGMC Capital. He sold his Adani Green bond exposure back in 2022. And he said that the fact that ESG funds are still in the company calls into question their ability to screen for these governance risks. So this situation really underscores the need for a deeper dive into how these funds are assessing risk, especially since they charge higher fees for their supposed expertise.
Yeah. It's a good point. And it's not just the funds themselves. This controversy also highlights the potential pitfalls of relying solely on external ratings. The SEC complaint notes that Adani Green used its A rating from MSCI's ESG research unit to attract investors.
Right. And while MSCI did eventually downgrade Adani Green to BBB in July, that was about 6 months after another short seller, Hindenburg Research, raised concerns. So it really begs the question, are these ratings agile enough? Can they keep pace with these evolving situations, especially in dynamic markets like India? This incident should really encourage investors to look beyond just the label and really delve into the underlying practices of the companies that they're considering.
Yeah, especially those that are being marketed as ESG friendly. So for our listeners out there, don't just assume that an ESG label is a guarantee of ethical and responsible practices. It's important to scrutinize the details. So understand the screening processes of the funds that you're investing in, and be aware of the potential for discrepancies between those ratings and reality.
Especially in those emerging markets.
Absolutely. ESG investing requires a critical eye, a willingness to go beyond just those surface-level assessments. Okay, let's shift gears now to a completely different market, Bitcoin. It's been on a meteoric rise. MarketWatch is reporting that it's nearing the $100,000 mark, and that's driving a surge in crypto-related stocks. So it has a lot of people wondering, are we seeing a replay of the 2021 market melt-up, which ultimately ended pretty painfully?
Yeah, there are certainly some parallels there. But this rally seems to be fueled by a different dynamic. MarketWatch highlights that the current surge is largely driven by expectations of more favorable regulatory environment for crypto under a second Trump administration. And this actually makes Bitcoin particularly susceptible to any policy shifts
Or disappointments?
So the current price of Bitcoin might be built on a foundation of anticipation, which makes it even more vulnerable to those sudden shifts in sentiment. MarketWatch quotes Mohan Ema. He's a portfolio manager at Beam Capital Management, and he warns that Bitcoin is currently priced for perfection. And this idea of being priced for perfection needs to be considered within the context of the current macroeconomic environment. We're seeing higher interest rates and bond yields compared to 2021, which creates a different landscape for risk assets like Bitcoin.
MarketWatch also quotes George Cipollone. He's a portfolio manager at Penn Mutual Asset Management, and he expresses concern that we might be headed towards another period of craziness in the market, which could lead to losses for investors. And while Citigroup's Levnikovich Index, it's a gauge of stock market sentiment, it hasn't reached the level seen in 2021. Its recent sharp rise is definitely a signal worth noting. So for our listeners, approach this Bitcoin rally with a healthy dose of caution.
Yeah, I think that's right. While the allure of those quick gains is always tempting, you really need to understand the factors driving this rally, particularly the weight of regulatory expectations.
It seems like navigating today's financial markets requires this delicate balance between enthusiasm and skepticism.
It does, recognizing those potential opportunities, but also being aware of the underlying risks and understanding that broader context in which these market movements are occurring.
All right, let's turn our attention now to North America. Trade relations are taking an interesting turn, the Wall Street Journal reports. That Canada is signaling a willingness to renegotiate the USMCA. That's the trade agreement between the U.S., Canada, and Mexico. But there's a twist. They're looking to proceed without Mexico at the table.
Wow. And this move is driven by concerns over Chinese investment in Mexico. Canada fears that that investment could be used to circumvent trade rules and potentially flood the North American market with Chinese goods that would otherwise face tariffs. So it really raises a fundamental question about the future of global trade. Is friendshoring a viable strategy in this really interconnected world that we live in?
Yeah, it's certainly a bold move, especially considering the historical context. As the Wall Street Journal points out, this comes after Canada faced protectionist policies from the Trump administration during his first term, and now they're seeking a bilateral deal with the U.S., potentially leaving Mexico on the sidelines.
And this situation just highlights the complexities of navigating global trade. In a world where economic and political interests often collide, the auto sector, which has these deeply integrated supply chains across all three countries, is likely to be a focal point of these discussions. Any disruption there could have significant ripple effects throughout the entire industry.
The Wall Street Journal quotes Canadian Prime Minister Justin Trudeau. He expressed concerns that Chinese investments in Mexico could be used to circumvent the rules of the USMCA. On the other hand, Mexican President Claudia Sheinbaum dismissed Trudeau's comments as just pre-election posturing.
It's interesting to see how these varying perspectives really underscore the challenges of trying to achieve a unified approach to trade in a region where each country has its own set of priorities and concerns.
The Wall Street Journal also quotes Doug Ford. He's the Premier of Ontario. He stated that Canada needs a bilateral deal with the U.S. and then a separate one with Mexico. So that suggests a potential shift towards a more fragmented approach to trade agreements.
It'll be very interesting to see how these negotiations unfold, what they reveal about the future of trade relationships in North America and beyond. Our listeners should definitely stay informed about the evolving trade landscape and how it might impact businesses and investments.
Absolutely. The interconnectedness of global trade means that shifts in one region can have ripple effects around the world.
Definitely. Understanding those dynamics is so essential for navigating the complexities of today's globalized economy.
All right. Let's wrap up this part of our deep dive by examining the U.S. dollar. It's been showing surprising strength, CNBC is reporting, that it's reached a 2-month peak against major currencies. This is fueled by weakening economic indicators in Europe and robust economic data coming out of the U.S.
And that divergence between the U.S. and Europe is a key factor driving the dollar's strength. CNBC points to weakening PMIs, purchasing managers' indexes in Europe, and these indexes are considered leading indicators of economic activity. A declining PMI suggests a slowdown in manufacturing and services sectors.
CNBC also highlights the contrast with strong economic data from the U.S., which further reinforces the perception of a diverging economic landscape. And this has implications for investors, because a stronger dollar can impact the performance of international investments.
And it's not just investors who need to pay attention. A stronger dollar can affect the cost of imported goods, potentially leading to higher prices. For consumers, it can also impact travel plans, making trips abroad more expensive for those using U.S. dollars.
CNBC also notes that ECB policymakers are calling for greater economic integration within the EU, potentially to mitigate the risks of a potential trade war with the U.S. Under the incoming Trump administration.
It sounds like there's growing concerns about the future of transatlantic trade relations, the potential for further rate cuts by central banks, including the Fed, the ECB, and the Bank of England, adds another layer of complexity to this already intricate global economic picture. CNBC reports that President-elect Trump is expected to appoint Scott Bessent as his new Treasury Secretary, and Bessent is known for his fiscal hawk stance, so his policy priorities and how they might impact the global economic landscape remain to be seen.
So for our listeners, the takeaway here is that the dollar's strength is a reflection of broader economic trends and geopolitical shifts, and its impacts extend beyond finance, affecting everything from consumer prices to international travel.
It's true. Understanding these connections is crucial for making informed decisions. In this increasingly interconnected world, we'll delve deeper into some other major stories in just a moment, so stay tuned. While we've been talking about these global trends, there's a pretty compelling story unfolding within the U.S. market. Really highlights the volatility of high-growth stocks. MarketWatch is reporting that Supermicro Computer, a server maker, experienced a dramatic surge in its stock price this week, like 78%.
Wow, that's an eye-popping jump. What's behind that? Such a sudden and significant increase.
Well, it's kind of a comeback story. Supermicro has been grappling with some accounting issues, delays in filing those regulatory reports. They even lost their auditor, Ernst & Young, earlier this year, and that caused their stock to plummet.
Oh, wow. So this recent surge, is that more of a relief rally then?
Exactly. The company announced that they secured a new auditor, and they submitted a plan to NASDAQ outlining their path back to compliance with filing requirements. So this news really instilled a renewed sense of confidence in investors, hence the dramatic upswing.
Makes sense. But MarketWatch does point out that despite this impressive surge, Supermicro stock is still down 72% from its peak in March. So that seems to indicate a long road to recovery.
It does. Regaining that full trust of the market is going to take time. Consistent positive performance. And I think there are still those lingering concerns about the previous accounting issues and that potential for regulatory scrutiny.
Yeah, that makes sense. It's a reminder for our listeners that even in what seems like a bull market, not all stocks follow an upward trajectory, and what might appear as a high-growth opportunity could quickly turn into
a high-risk gamble.
Exactly. It emphasizes the importance of thorough due diligence, diversification, especially when you're considering those companies that are experiencing such rapid growth. You really have to scrutinize those financial reports and understand the reasons behind any significant stock movement. Okay, so let's zoom out a little bit. Consider the global economic landscape. It seems like it's entering a phase of heightened uncertainty. The Wall Street Journal reports that the Federal Reserve is likely to slow down the pace of interest rate cuts, as the U.S. economy is demonstrating greater resilience than initially anticipated.
And the market is already reflecting this shift in expectations. The likelihood of a rate cut in December has dipped to just over 50%. And the projected total amount of cuts by the end of 2025 has decreased significantly.
Just a few weeks ago, a more aggressive easing cycle seemed almost certain. What factors have contributed to this change in outlook?
Well, there are a couple of key factors at play here. Firstly, the U.S. economy has proven to be more robust than anticipated, with certain sectors performing better than expected. And secondly, the market is factoring in President-elect Trump's proposed policies, particularly his trade tariffs, which are expected to have an inflationary impact.
So the Fed might be hesitant to cut rates too quickly, to avoid fueling that inflation.
Exactly. It's a really delicate balancing act. They need to support economic growth while also trying to keep inflation under control. So the upcoming release of the Fed minutes next Tuesday will be very closely scrutinized for insights into their decision-making process.
For sure. The Wall Street Journal also highlights the importance of the upcoming PCE inflation data. That's scheduled for release on Wednesday. Another critical data point for the Fed to consider.
Yeah, the PCE, or Personal Consumption Expenditures Price Index, is the Fed's preferred measure of inflation. So that will carry a significant weight in their deliberations.
So it seems like next week will be pivotal for the U.S. economy. And could have ripple effects across global markets.
Definitely. It'll be fascinating to see how these various economic indicators, policy decisions interact, and how that shapes the financial landscape in the coming weeks.
Shifting gears to a slightly lighter topic, it seems like Elon Musk has once again managed to avoid any significant repercussions for his, let's say, unconventional behavior.
Oh, what has he done this time?
Bloomberg reports that a judge declined to sanction him for missing a meeting with the SEC to witness a SpaceX rocket launch.
It seems Elon Musk has a very unique ability to bend the rules without breaking them. I'm not entirely surprised by this outcome.
He definitely doesn't fit the mold of a typical CEO in this instance. It appeared he avoided those sanctions by agreeing to reimburse the SEC for the travel expenses incurred by the lawyers. That he stood up.
Seems like a relatively small price to pay for a front row seat to a rocket launch.
It does. Makes you wonder what it would take for Elon Musk to face any real consequences for his actions.
Right, that's the question for the ages. For now, it seems. He continued to operate under his own set of rules.
All right, back to a more serious matter. Barron's reports that the stock market's upward momentum remains undeterred by Russia's nuclear threats.
That does seem a bit counterintuitive, given the potential for a global catastrophe. However, as Barron's points out, history shows that geopolitical events tend to have a relatively short-lived impact on equity returns. The market typically prioritizes factors like earnings growth, interest rates, and corporate tax policy.
Okay. It's like the market is operating in a separate reality, detached from those real-world anxieties
Yeah.
about nuclear war.
Barron's actually quotes Christopher Smart, managing partner of the Arbroath Group, who suggests that while the use of a nuclear weapon would undoubtedly have those devastating consequences for the global economy, investors appear to be betting on the low probability of that scenario actually happening.
a gamble.
It is. But as long as those corporate profits continue to flow and interest rates remain relatively low, the market seems content to disregard that geopolitical noise.
Okay. On a more positive note, CNBC reports that gold prices are surging, on track for their best week in almost 2 years.
That's not too surprising, considering those heightened geopolitical tensions and the uncertainty surrounding the global economy. Gold is often viewed as that safe haven asset during times of turmoil.
Right. CNBC is attributing this gold rally to a combination of that safe haven demand
Yeah.
and then the escalating conflict between Russia and Ukraine.
And that uncertainty surrounding the future direction of U.S. interest rates is also playing a role. Gold tends to perform well when interest rates are falling or expected to fall, as investors seek out alternative assets that can preserve their capital.
So for our listeners, gold might be worth considering as a potential hedge against market volatility, especially given that current geopolitical and economic climate.
Yeah, I think it's definitely an avenue worth exploring, especially for those looking to diversify their portfolios and mitigate those potential risks.
So this week has presented us with a real mixed bag of financial news. ESG controversies, Bitcoin's volatility, trade tensions, and even the specter of nuclear threats.
It's true, the interconnectedness of these global markets and the speed at which things are unfolding makes it more important than ever to stay informed and adapt to that ever-changing landscape.
And in the midst of this whirlwind of information, it's essential to prioritize those credible sources and develop a discerning eye to really differentiate between the noise and valuable insights.
Well, absolutely. Critical thinking and the ability to filter information are crucial skills for navigating today's financial world.
Speaking of navigating that complexity, we've got one more intriguing story to unravel before we wrap up this deep dive. It involves a familiar player in the tech world, Apple. Let's delve into that now. The Wall Street Journal is reporting that Apple is facing scrutiny from the U.S. Justice Department over its App Store policies, specifically those related to in-app purchases and the fees that Apple charges developers.
Well, this isn't the first time that Apple's App Store practices have come under fire. They've been the subject of numerous lawsuits and regulatory investigations. Critics argue that Apple's control over its app ecosystem stifles competition and unfairly burdens developers.
The Wall Street Journal highlights that the Justice Department is particularly interested in whether Apple's policies are designed to give preferential treatment to its own apps and services, potentially disadvantaging rivals.
Right, and this investigation could have significant implications for Apple's business model, which relies heavily on revenue generated through its App Store. It also raises those broader questions about the power and influence of these tech giants and the need for more robust antitrust enforcement.
For our listeners, this story serves as a good reminder that even the most successful companies aren't immune to regulatory scrutiny. It highlights the importance of understanding the competitive landscape and any potential legal challenges faced by the companies that you invest in or the products and services you use.
Absolutely. I think it's a testament to the evolving nature of the tech industry and the ongoing debate about how to strike that right balance between innovation and fair competition.
Well, we've covered a lot of ground today. ESG controversies, Bitcoin's volatility, trade tensions, the power dynamics of big tech. It's been quite a whirlwind tour of this week's most impactful financial stories. I think it highlights the interconnectedness of global markets and the need for that discerning eye when you're navigating, that constant flow of information.
Yeah, it's true. Staying informed and being able to connect the dots between those seemingly disparate events is more crucial than ever. In today's complex financial landscape, it's about understanding not just what's happening, but why it matters and how it might impact your own financial decisions.
Absolutely. We hope this deep dive has provided you with some valuable insights and a deeper understanding of the forces shaping the financial world. Remember, knowledge is power. And in the world of finance, staying ahead of the curve is key.
Couldn't agree more. We encourage you to continue exploring these topics, asking questions, and seeking out those diverse perspectives. The more informed you are, the better equipped you'll be to navigate the market and make those sound financial choices.
And on that note, we'll see you all tomorrow morning with new headlines from the major financial magazines